XRP just did something that should terrify every single holder who bought the "to the moon" story, and almost nobody is talking about it. While you were watching the price bounce around $1, wallets holding over 1 million XRP quietly dumped more than 30 million tokens straight onto exchanges in the last 5 days. That is not a rumor, that is on-chain data. And at the exact same time, Goldman Sachs, the same bank that just months ago exited its entire XRP ETF position and sold over $150 million worth of the asset, has now turned around and disclosed a fresh position worth roughly $153 million across 4 spot XRP ETFs. Wall Street's biggest bank just became the largest institutional holder of XRP funds. Sell everything, then buy it all back. Why would they do that? Stay with me because this story gets stranger the deeper you go. Let's start with where XRP actually sits right now. The price has been grinding near $1.13 after falling more than 3% in 24 hours and underperforming a broader crypto market that is already weak. Network activity on the XRP ledger has collapsed during this same stretch, which is the kind of detail that usually gets buried under price talk, but actually matters more. A blockchain built for cross-border payments is supposed to show rising transaction volume if institutions are really adopting it. Instead, activity is shrinking while the token gets dumped by its biggest holders. Sentiment data backs this up in a way that should make you sit up. Santiment's weighted sentiment gauge for XRP just hit its weakest reading since October of last year. Glassnode's on-chain data shows holders are in what analysts call capitulation, meaning long-term believers are finally throwing in the towel after months of sideways pain. Historically, this is exactly the kind of moment that precedes a bottom, because the weak hands are the ones still selling, and once they're gone, there's nobody left to sell. But historically is doing a lot of work in that sentence, and nobody rings a bell at the bottom. Now here's where it gets genuinely interesting, because the derivatives market just delivered a signal most retail traders completely missed. Open interest in XRP futures dropped nearly 15% in 24 hours, triggering more than $6 million in long liquidations. That means traders who bet on a bounce got wiped out fast. And yet, buried underneath all that carnage, the amount of XRP being pulled off exchanges has exploded. On June 22nd, roughly 40.7 million XRP sat in that moving off exchange category. Within days, that number tripled to about 123 million XRP. When large amounts of a token leave exchanges, it usually means holders are moving into cold storage instead of preparing to sell, and that is the opposite of what panic looks like. At the same time, institutional money keeps quietly flowing in through a different door. XRP ETF inflows have now been positive for 8 straight weeks. The week ending June 26th alone added almost $23 million, pushing cumulative net inflows since launch to roughly $1.47 billion. So you have retail derivatives traders getting liquidated, large XRP holders technically capitulating on-chain sentiment, and yet institutions steadily accumulating through regulated ETF products almost every single week. 3 completely different groups of people, 3 completely different signals, all happening on the same asset at the same time. But not every institution agrees on where this goes next. Standard Chartered just slashed its XRP price target from $8 all the way down to $2.80, citing the fact that ETF inflows, while still positive, have slowed dramatically compared to their launch pace. That is one of the biggest single-day target cuts we have seen from a major bank on this asset, and it landed just as Goldman was quietly building its new position. 2 of the most influential names in finance moving in almost opposite directions on the same week. Then there's the technical picture, and this is the part chart traders are obsessing over right now. XRP has been trapped inside a falling channel that stretches all the way back to July of last year. Multiple attempts to break above that trend line have failed, most recently in January and again in May, both times getting rejected right at the upper boundary. The 20-period exponential moving average now sits directly on top of that same trend line, meaning if price finally breaks above it, both barriers get cleared in a single move. The first real hurdle sits near $1.18, followed by resistance around $1.22. On the downside, the psychological $1 level has been defended by bulls for over a week straight, but a break below that support opens the door toward 85 cents according to several analysts tracking current momentum. While all of this price drama plays out, the actual technology behind XRP just went through a major overhaul that barely made headlines outside crypto media. The core software that runs the XRP ledger was officially renamed from Rippled to xrpld as part of version 3.2, a symbolic but significant shift signaling a new era for the network. This update hardened the ledger's vaults, its lending protocol, and its permissioned decentralized exchanges, all of which are the exact infrastructure pieces institutions need before they'll trust real money to the network. Ripple also brought in an AI-assisted red team earlier this year, specifically to hunt for vulnerabilities before they ever reach the main network, a move straight out of traditional finance's playbook for securing critical infrastructure. One of the most overlooked developments came directly from XRP Ledger co-founder David Schwartz, who just unveiled a new transaction reservation scheme designed to stop front-running on the network's decentralized exchange. Front-running has been one of the quiet problems holding back serious DeFi activity on XRPL, where bots could see incoming trades and jump ahead of them. If this fix works as intended, it removes a real barrier for professional trading desks that have been hesitant to build on the ledger. And then there's the drama that always gets clicks. Ripple CEO Brad Garlinghouse publicly clashed with Michael Saylor this week, criticizing Saylor's Bitcoin as store of value strategy and reigniting the long-running debate over whether crypto's future is about holding value or actually using it for payments. It's a fight that's been simmering for years, but with XRP's utility narrative under pressure from weak network activity, the timing of Garlinghouse going on offense is not exactly an accident. So where does that leave XRP heading into the rest of this month? You've got whales dumping on one hand and quietly accumulating in cold storage on the other. You've got Goldman Sachs exiting and then re-entering within months. You've got Standard Chartered slashing its target while ETF inflows keep printing green for an 8th straight week. You've got a token stuck in a year-long downtrend, sitting one clean breakout away from finally clearing it and one support break away from a much deeper slide toward 85 cents. Every signal on this asset right now is pointing in a different direction at the same time, and that tension is exactly why the next few weeks matter more than almost any stretch XRP has seen all year. Make sure you're subscribed before this breaks one way or the other, because whichever direction it goes, you'll want to have seen it coming.